which I joined 3.5 years ago, almost 4 years ago, is a single family office that is the wealth, investment wealth, active investment wealth for the Gominda Pratt family, so the side of the Pratt family under Fiona. And Rafi Gominda is the executive chairman of Pact, which is one of the packaging companies that he listed. So since listing Pact and with some of the other assets, myself, as one of the early people have, and a team of another 15 in the office, have built a world-class investment office for Melbourne. We now invest in global markets in our key platforms of manufacturing, fast-moving consumer goods, financial markets, technology, and real estate. The one that stands out a little bit there for most family offices is technology. So as we'll talk about, I'm sort of one of the first family offices that has a dedicated technologists working in it. We like to think we're a lot more than money, so we believe that, and I'll explain this a little bit more detail, but we believe that anything that's easy in technology has already been done, and most of the next disruptions are going to require more than just digitizing. There's going to be structural, we mentioned agtech before, it's not just about farmers buying software. We all know that's not going to solve the farming problem. It's not going to solve drought, So a lot of these problems are going to require collaboration and approach and enterprise, corporates, everyone to be a part of it. And I think the skills within the office are an entrepreneurial base, but then work all the way through IPO and scaling businesses. So we believe we can add a lot of value. As I said, we believe that if you believe in the hypothesis that the world is fundamentally going to change and continue to change, you can't then not have technology as part of that. It's obviously been a huge disruptor. So the reason for bringing me into the office was to really make sure that we had somebody at the table that was evaluating it just like you would evaluate a manufacturing business. There's someone who can evaluate a technology business. There's someone who can evaluate property and its investment. And then we collaborate on how we feel that the investments will suit what we're trying to do long term. I'm not someone that reads slides. They're just someone who has to stare at me. So hopefully you can read them. If not, there's on our website. So. We talk about leading edge a lot. Again, I'll talk about this in a moment, but there are innovation cycles, and innovation cycles are getting slower. And if you want to be an investor that makes exceptional returns or returns outside the market, you need to invest at the beginning of an innovation cycle, not the end of the innovation cycle. And so this takes a lot of patience and it takes a lot of timing, and it means you often don't do deals. And this is a very hard concept for a lot of people to do because they often give, and I'm not a fan of funds, so apology for people who have background and understand funds, but my problem with funds is you've now been allocated capital, and the people that are managing that money feel a need to allocate or to spend their capital. Because if they don't, they're not doing their jobs. But the problem is if there's nothing good for them to put the businesses in there and in the wrong time in the life cycle, very few of them will stand up and hand you your money back and say, you know what, there's probably a better place for it than here, right? They're just deployed into things that are not going to give you a great return. So 15% of venture capitalists globally actually make their limited partners, the people who give them money. The rest of them lose their money. And that's a pretty bad statistic, and it is a risky game. So don't think that the washing of how wonderful innovation is and that next startup maybe it's going to make lots of money. Don't get lost in that too much. You can, but it is patience, and it's also, I think, a lot of work. The other thing I want to point out here is we have a 100-year vision. Most funds have 5 to 7 year vision. They want to basically make the investments, get the exit, and give you your money back in 7 years. I think most of you look like you've lived longer than 7 years. I think it's going to take longer than that to actually meet anything meaningful. With a company that was mentioned before, Aconex, it started in 2000. I joined in 2007. I left in 2015 when it listed, and it was bought by Oracle last year for $1.6 billion. So that's 18 years. So we don't want to be a 5 to 7 year flip kind of thing. We want to be in companies that are going to grow and may grow for 100 years. We're also quite different in that we don't just invest, we also operate. So a lot of our portfolio is operating. We sit on the boards of all of the companies that we are investors in. And I guess I was hired for this role because I'm an operator of technology businesses, rather than I'm a banker or an investment finance professional that can make the decisions on the numbers. I make the decisions on the people and the problems they're trying to solve. As I already mentioned, we are all entrepreneurs, so we have all stood at the coalface and started a business and started an idea and had to rely on funding and others to help us get there. So we believe that it's a unique perspective to attract the right kind of companies to us. And I'm going to go into this in a little bit more detail, but we chose an approach which was to be very deep and thematic in our investing. And by the way, thematic is kind of an awful word, but it's the best way to describe that we do not invest in technology in anything that is outside of these 4 areas. And we believe that we either have a unique position to deliver in these areas, or we have the scale and ability to actually make technology businesses that are around these things do very well, or we just actually care and think it's really important for Australia, because we're an Australian-based family office, so this is where we want to invest our money. So they are, and I'll go through them in a bit more detail. So intelligent manufacturing, the family's DNA is packaging, manufacturing, recycling, so they kind of get it. So it's going to be completely, most of it is automated, there's a lot of robots, there's a lot of dark warehousing, there's a lot of things already happening. The Industry 4.0, the lot size of 1, being able to print you something that you want and then it falls apart when you don't need it anymore and goes back to the earth, that's hard, that's not easy. If it was easy, we would have already done that. So we really believe that it's going to be the manufacturing capability, particularly around food and beverage, which will have to be packaged for a long time. I don't know if anyone's tried to drink water out of your hands lately, but it's kind of difficult. So we can't just sort of say don't use packaging. It is not practical. Consumers don't like friction. So we have to look at how we're going to manufacture things to be more synthetic and sustainable for the future. The future of food and wellness. So again, as we move through science and start to get more understanding of the human brain. I mean, we have so little understanding of how we as humans work. There's a lot of stuff around diagnostic health, DNA, things that are specific to your body, and an interesting awareness by consumers. But also, we think that there's going to be more and more mouths to feed. We've got to think more about how we use the land, the resources of the land. Technology and nutrition are going to become interconnected. And the way maybe nutrition is deployed, or the way that you might have had it in the past and how you'll get it, whether it's through what we use as in a stent in a heart now, might be something different in the future. We really want to, and have been focused very heavily in this area. So don't get me started on plant protein, because I can bore you silly on it. So trust is the next platform. We actually started this 3 years ago before everyone sort of realized the problems that are coming with fake news, but we fundamentally believe that it's a human right. I mean, you know, humans have been letting humans down for millions of years, but generally 99% of us are good people, and we deserve to be, you know, to have a world around us where we can at least have some level of trust that this is something that we can open, and we don't believe that it should be your responsibility to protect yourself from the world. You know, it is a responsibility of us all to keep us all safe, just like a community does. We have seen amazing amount of stuff around this. It is not cybersecurity. So again, we do not invest in cybersecurity because we don't believe that is a thing. That is fear trying to convince you that something is dangerous. It's not trust. So we're very clear on that. And the last thing is everything as a service, and I'm going to go into this a bit more, but the age of ownership is ending. Many of you may own your houses, many of you may own cars. If you look at my son, he's 9, he's probably never going to own any of those things. why would he take the capital that he has and puts it in something that he doesn't have to, and he can still have the benefits of it, and he can spend his capital on other things assuming he has some way of making an income. We'll let him worry about that. But I mean, everything that we're doing, and this is one of the things I think has caught most retailers and everyone else by surprise, is everybody just wants it now and they don't want to pay a lot for it. And that is hard. I think the hardest thing for most of our economic models, I think our, the global markets, it has a profound, the way we have taken our economic models and thought about the world and how it makes money and GDP and all of these things, I think is going to be fundamentally changed by this. And I think, unfortunately, it is going to be a bumpy ride for many things that have been consistently, fixed income, bonds, things that have always been safe, I think are going to be harder to be safe, because this is just changing the nature of what an asset is and who owns the asset. So I just wanted to quickly, I didn't know I didn't have much about all of you. You got more on me than I did on you. So I just wanted to kind of talk about the stages in Australia of investing, because there are lots of people, and you read the newspaper about someone raised money today. AFR was just on the front page about a new unicorn in Australia. So I just wanted to kind of take a little ready reckoner of what kind of investing happens. So this is a slide I'll go through. So if we start at the left, we have angel funding. We also call this family, friends, and fools. So typically this is the first amount of money that an entrepreneur will get, and it tends to be someone that knows them and is willing to give them a go and wants to help them. It's usually not very well structured. They may not have an active role in the business. It's just an intent of well hope. The business is often at an idea stage, so I'm now going down underneath that. The founder needs some help to build it, but often they can do that on their own. They typically value the business between $1 and $3 million, so it doesn't have a lot of value. I know a lot of you that value businesses on revenue find that it's extraordinary that it's worth that with no revenue in it, but that's venture investing. And there's nothing you can really do to de-risk it. That sucker is either going to go somewhere or nowhere. There's not much that your ability as an investor is to add. If we move one over, we've got C. So you've got an MVP is a minimum viable product, so you actually have something that people are saying they like. The founder needs some initial market entry. It might be an introduction to a bank or to someone to validate the model. The valuation goes up slightly, and typically you're needing to build something. So you need some sort of engineering, software, mechanical manufacturing, electrical, whatever. Post-seed is a kind of a new stage that's emerged in the Australian market, which is you're kind of there, but you're not all the way to being revenue generating. So that's just showing rewarding early traction. The valuations tends to go up a little bit, but this is where the commercial capability, the ability to now have a revenue model, figure out how people are going to pay you, costs to delivering your services, how you're going to scale, how you're going to deliver these things globally. This is where you start to think about these things. Series A, you've got clear market fit. You're usually $5 million or above in revenue. You're expanding into other markets. So if you started in Melbourne, you're in Sydney. We would recommend you don't go overseas until you've got a good, secure market. Australia is a small market, but it's not tiny. So you should be able to have a good business in Australia before you go somewhere. And you need some, again, early scaling, early customer support. And then growth, you've got market leadership. You're usually in multiple markets. You're usually 30 million, your revenues are often up above 15, 20 million. And you're looking now for scaling, distribution, and strategic fit. So we typically, we have invested across the stage over the last 3 years. After doing a review of the portfolio, we have decided that growth is actually the one that makes the most sense for us, so the one on the farthest right. And there's lots of reasons for that, but we can scale really well. We aren't so good at you driving your car in circles in the car park. We just kind of, we go, don't do that, and they just keep doing it. So we really find the ones that know very clearly what they want to do, and they want us. It's kind of money meets happiness, and we are able to help those businesses a lot. This is what I was talking about before. So these are there's different versions of this. It initially was a Russian guy whose name I struggled at practice, but I can't say now. And then this guy took it on, and basically talking about the accelerating of waves. So if you look from 1785 through to 2020, which is next year, you basically can see that the pace of innovation is getting quicker. So we went from 60 years along the bottom to now going through the 5th wave, which we did in 30 years. And we kind of did things like water power, textiles, we did steam, rail, steel, electricity, chemicals, the internal combustion engine, petrochemicals, electronics, aviation, and now we're into the digital network software and media. And this is where I was saying you need to be careful where you invest if you are to invest. So most people are investing here, right? We're in 2020. If you're deploying money at the moment, you're at the bottom of an innovation wave, which means anyone that is invested here has already made their money and is out, and you are coming in here. So the question everyone wants to know is here. And depending, where is this next one? And some people will tell you it's AI, and some people will say it's machines taking over decision making. But we fundamentally believe that what has happened, that what the 5th wave really has delivered is the global age of consumer. So if you can't hear me, let me know. I tend to be quite loud anyway. So we started with the internet. So this is sort of over 30 years, right? We got the internet about 30 years ago. We then got these platforms, and these platforms allowed us to have open source software with the phone that many of us use, social networks, cloud-based storage, and the ability to not have to own your own infrastructure, and then the ability to start having big data. And then this was really won by a bunch of very wealthy companies that now kind of have a very tight hold on it. And then from that, all these startups were able to deliver software, SaaS, software as a service, applications, products, gadgets. And now you've got these whole communities of things globally, like Alibaba, JD.com. These are billion-dollar companies. You've got Lyfts, you've got Ubers, right? So you now have a consumer who wants frictionless. They don't want to. So the example I use is that if you are in a city that has both Uber and Lyft, here in Melbourne, there's one called Ola that compares with Uber. If an Uber car is going to take you 10 minutes to get to you and you flip to Ola and it's 3 minutes, you go to Ola and you take the car that you only have to wait 3 minutes for. You don't wait 10 minutes for the branded car. You don't care about the brand, you care about the service. So we fundamentally, our belief is that next innovation point is going to actually be that service, so enterprise as a service. So whatever you've been delivering in your more traditional businesses, people now want that as a service. So it's going to require you to still manufacture something. So again, we think of it as beauty equipment, vitamins, beverages. Why can't you just get a can of Coke now? Why do you have to go to the supermarket on a Sunday with everybody else and buy a 6-pack? I just want a Coke now. I'm gonna bring me a Coke, I can get an Uber, I can get a Deliveroo. You know, and then how does Coca-Cola as a company actually provide that service and actually keep that brand loyalty and make sure that they get a Coke and they don't go and get a Pepsi from someone else, right? So that's where and that's actually quite hard because technology entrepreneurs can't solve that problem. They need Coke, or they need this supply chain, they need the people who are actually going to, who own that and or replace it and disrupt it. The other thing that's really interesting, and this is a report from the Silicon Valley Bank, which I don't think I've updated correctly. It says in the bottom. So the Silicon Valley Bank, based in California, does a report of the state of the nation in investing every quarter, and it's always an interesting read. But as they say in their front thing, in most industries with competition and technology advancement comes disruption. It would be ironic if the venture capital industry was any different. So the state of investing in ventures is changing even quicker than I guess the innovation cycles that we showed before. So venture capital actually initially came from funding Hollywood films. That's where the concept came from, that nobody could actually afford to pay all of the money to put into starting a film and all the crews and everything like that, so people would pull their money together to get a film off the ground, right? Unfortunately, someone decided that was a great way to continue to do it with technology companies, and that's sort of what started this sort of cottage industry. People knew who was willing to put small amounts of money, they grew into funds. But then we kind of went through a capital boom, a dot-com bust. We started to get capital as a service, so people could just keep getting money without having at increasingly higher valuations. And then what's started to happen now is founders are starting to get control. So what the axis on the vertical axis is trying to say is founders are at the bottom of the companies, and the venture people that had the money used to be at the top. And what's happening now is the founders and companies are starting to get a balance of control now, where there's lots of capital, and there are some really good founders, and it's meaning that you can't just park your money in venture and get a return now because that balance of control is gone. And you can see that venture capital is having to change. There's increased non-traditional investor participation, so family offices are now responsible for 40% of the direct investing in all technology companies in the US, right? And that's gone in 20 years has gone from being 100% to now this 40% market's come up. There's much bigger fund sizes. There's many funds now that are in the over $4 to $8 billion of funds that can follow on investing minimum. So SoftBank writes a minimum of $100 million in their checks. There's new operating structures. There's a real push to diversity now, which is an awesome thing in not only the people that are deploying the money, but the strategies, the sectors supporting businesses around women's health, migrants, acclimatation, and then also data-driven capital as a service. So we're seeing revenue-based financing now where you can actually connect into a company's bank account and actually see live their cash transactions and then lend them money real time if they look like they're going to fall down on their cash, and then pull out an interest payment if at the end of the month if they don't need that money again. And you can have a warrant where it kicks in if you decide that they're not going to give you back, and you start taking equity at that point. So it's really very disruptive, and to be fair, there's a lot of people kind of in Australia saying they're doing it, but we're kind of doing it for the first time. Instead of picking up the US venture models and trying to do them in Australia, there's sort of something that's happening around the same time. And I think the US have better learning and better data than we do here. We're still not an industry that really shares very much. So we don't, whereas in the US they share a lot, so they know what your investments are doing and what other people's investments are doing. So what's next? This is my sort of summary slide. Hopefully I'm on time. Every industry is being remade into mobile internet's likeness. Media, retail, transport, everything. The hardest thing for most startups today is the path to market. So first you've got to find your product market fit, then you've got to get customers, then you've got to build a ruthless machine to acquire, monetize, and retain them. And this stat, which is from the Silicon Valley Bank as well, is startups are spending almost 40 cents of every dollar of investment that's given to them on Google. So they're paying for search engine optimization so that their product is found above their competitors. Facebook, they're paying for consumers to like them or to share them with their friends. Or Amazon, which has the world's largest infrastructure for supporting cloud-based startups. So, as a, cluey investor, I could give my money to Google, Facebook, and Amazon and not have the execution risk, right? Because those stocks are going to keep going up as long as that's going to keep happening. And if I, and I think that's ultimately the challenge, is that these monoliths and these companies are now getting so big that they're actually causing some potential disruption problems from underneath. There's a company that was in the paper yesterday called Sinclair, was very successful, was about to list in an IPO, that Facebook pulled their arrangement with them and completely killed that business, which was about to IPO. Now it may save itself, but you have to imagine if you're the customer that was provided on that service, which was effectively scraping people's Facebook profiles for interactions with your service. So say you'd gone to a restaurant and posted a photo, it would go to everyone's profile, find that you had that restaurant, and then allow the restaurant to show the consumers all the photos of the people in the restaurants. If you as a restaurant don't get that feed anymore, do you care that Stack was out of business? You just go find somebody else that gives it to you. So it's very interesting dynamics. Most startups are coming to you and tapping you on the shoulder, if they are, or who are asking you for money. they're actually looking for money to pay these guys, these big tech companies, to do their service. There's actually not a lot of money going into real innovation in R&D, which was essentially what venture capital was, and you know why universities and all of these things that are doing really interesting research should be where we all spend our time. I already said I'm a bit of a cynic to VC. So VC models are all about raising funds. So the way a venture capital model works is it's 2% management fee, and then you get a carry on the upside. If you raise a small fund, that 2% is not much. But if you raise more and more funds, so now you're raising a $1 billion fund, that 2% suddenly means that you're not aligned with the people that gave you money anymore, because you can live on the management fee, but you don't have to. You can't live on the carry. And so we believe that this will eventually be the end of some venture capitalists who don't actually understand that the true alignment through all of this is money and entrepreneurs. And if you're going to be in the middle taking a clip and not adding value, you're just going to be inefficient. And it's a service. So, and people who can provide the capital, lower touch, less frictionless, and add value will be natural sources of. And that can be many of these people around the table. I mean, there is a lot of startup and early entrepreneurs and early ideas need that you can contribute as well as your capital. And if you see real innovation in R&D, then I recommend you put a small amount of money in it, because it'll be the best return that you might get from my perspective, and that's what we hope we're doing.